Well, as interest rates continue to dictate the strength of Canada's housing market, Robert Hogue, Assistant Chief Economist at RBC, says 2024 will be a year of two halves, with activity expected to pick up once rate cuts are announced. But despite lots of pent-up demand, he believes poor affordability will hold back market recovery this year. Robert Hogue joins us now. Thanks so much for making time this afternoon.
Well, thank you for the invitation.
Well, interest rates, they're front and center today, especially with the U.S. Federal Reserve's latest rate decision. And in that example, pushing back on rate cuts and even the possibility of a rate cut in March, pushing back on that specifically. Just how much does the housing market hinge on the trajectory for interest rates in this country, also in the U.S. as well?
Yes, and our view is that it very much so hinges on interest rates, and that's been the case since March 2022, when the central banks started to hike rates in a very, very big way. We've seen the market now correcting quite significantly over the course of 22 and most of 2023. And our view is that as long as interest rates remain as high as they are today, activity will be pretty calm. We're not expecting any kind of very significant rebound until there's going to be a cumulative, a large enough cumulative drop in interest rates that will get start to open the door to more buyers coming into the market and then get things going. And as you pointed out in your introduction, the type of recovery we're thinking about for the market is much more gradual rather than a very sharp snapback in activity. Because affordability will still hold back many buyers and keep them on the sideline for a period of time.
It is interesting, Robert, because when you think about last year when the Bank of Canada was just signaling a pause and what that managed to spark in terms of activity in the housing market. But this time around, that sounds very different, that there might be the need for multiple rate cuts to happen before, there's a real pickup in activity out there.
Right, and I think the last year's episode might be a little bit of a lesson about for buyers to wait until the rate cuts are actually delivered and not just anticipated. And so maybe that might be something that will contrast this year rather compared to last year. And by the way, last year's rebound, as surprising as it was not sustained. We see it almost entirely reversed overall in Canada. It was totally reversed in Ontario, for example. Again, affordability is still a major issue for many buyers, and in our view, that this will continue to be holding back any kind of recovery.
Yeah, we were just taking a look at one of your graphs there with the forecast for prices, and it does look like you're expecting them to climb over the next 2 years here, but not that sort of angle that we're looking at is not the sort of steep climb that we did see a couple of years ago before interest rate hikes started.
Well, absolutely. And I think in a very short term, we do expect further price declines, certainly in certain markets across Canada and Ontario and BC, for example. And then once the bottom is hit, I just really want to reemphasize we're not expecting a snapback. It's going to be a fairly gradual recovery. We call it a gradual liftoff. And then maybe the more hefty price increases will probably happen delayed into 2025 and possibly beyond.
You talked about the affordability problem that you're expecting to still persist, and we've got another one of your graphs that highlights or illustrates the affordability scenario, and you can see that I think when it's declining a bit at the end there in your forecast, that's affordability improving, but it is not near the levels of pre-pandemic, even when that might have still been a stretch when it comes to affordability.
Right. And apologies to potential first-time home buyers here. No, we do expect a certain degree of improvement in ownership affordability, but no, very minimal when you compare it to how much the affordability has deteriorated during the pandemic. So a little bit of relief, but no, really not a game changer for many potential buyers out there.
And as we head into this period of mortgage renewals for a lot of Canadians as well, with interest rates still at these elevated levels, it does raise the question about how people are going to handle things. But you have got another graph. I enjoy the show and tell here. So we've got another one of your graphs, Robert, that looks at Canadians being able to meet their debt obligations. And this is the percent of total mortgages that are in arrears as a percent of all total mortgages. And that looks very low there, Robert.
It remains exceptionally low. And you can large part thank the stress tests and those prudential measures that have been put in place years ago now to make sure that mortgage borrowers are able to withstand a significant increase in rates, which is what we've been experiencing. So, but that said, we do expect that mortgage delinquencies will kind of edge higher in the period ahead. But as the chart clearly indicates, we still have a long way to go go back to where we were before the pandemic, which was not high. That delinquency rate was still exceptionally low at the start of the pandemic.